Fear of missing out on markets will probably go on for the next decade or so. And it depends on what's going on. When markets are doing well, retail investor feels they got to be involved. And if the market's running, then they feel they got to catch up. Therefore, you got the Fomo issue with regard to what's going on. The issue with that, Brian, is that it's an emotion. It's an emotion. And I think whenever you're dealing with the marketplace, whenever you're looking at your portfolio, when you're looking at the economy, while it may get emotional sometimes, you cannot make decisions emotionally. So you got to step back a little bit. You got to take a deep breath, and you've got to go back to what you believe your strategy is, or what your process has been in terms of making decisions. But emotion cannot get in the way. Can't get in the way on the way up. Can't get in the way on the way down. But I do acknowledge that it's part of the market today right now.
Joe, you're on the ground floor of the retail investing movement. I hate when people tell me that the retail investor is unsophisticated. They don't know what they're doing. I've always found a lot of these investors to be very sophisticated and certainly take a lot of pride in what they do. What's your message to these investors that have been trading this market even higher this year, in some cases chasing performance? What should they be doing today?
Yeah. Well, Brian, I think, for the ones that really see in the real world, right, there are many retail investors that are very sophisticated, really know what's going on. Then there are some that really just are not and really don't get in the market too much. They don't worry about it too much. And when they do, it might be an emotional trade. But when you have an understanding in terms of what's going on in the markets, as I said a minute ago, you've got to have a disciplined strategy. So the markets have hit all-time highs. We've come off a bit, but they're still really up there compared to where we were 6, 12 months ago. And I think an important part of investing is you've got to be able to trim. When the market's going up, you got to be able to take something off. Like every 10% of something's got to come off the table. Not all of it, unless there's something you don't like anymore. If the reasons why you bought it are still the reasons why you hold it, that's great. But when you've had a nice run, you got to trim some. By the same token, if there were a big correction, things that you like, you should be adding to that. One last point, Brian, and that is, it's a fair argument to say, it's hard to get in now because we're at our highs. That's where I think you get dollar cost average. And I don't care if you're an institutional or an individual investor. You trim into strength, you buy on weakness, and you dollar cost average when you want to get involved with something, but it's near its highs.
Joe, I'm sure you've seen some of this action the past week in Open Door, one of the most active ticker platforms on Yahoo Finance. What do you think about social media driving sentiment and stock price swings at this point?
Well, social media is pretty powerful. You go back to when we had GameStop and the whole meme craze, which exists a little bit today. Now it's not as vigorous as it was a couple of years ago or whenever it was. But I think if you're an individual investor and you follow some of the blogs, right, whomever it might be, and you're part of those respective chat rooms, and something kind of strikes your fancy, even if you don't quite understand exactly why that particular stock is a good buy or not a good buy, you do understand that there are people you like and trust and believe in, even though you may not know them, that are getting involved. So you tend to get involved. Now, once you do that, I would say the exact same thing I said a minute ago. You can't get in, buy something at 5, and then it starts to go to 10, 15, 20, 25, 30, 35, 45. Just keeps going, and you just sit there and not do anything about it. You got to start to trim. If it's 40, 50, and 2 days ago it was 5, you got to be really careful about whether or not you're going to get involved with the market. So what the typical meme trader doesn't have is risk management tools. If they had more risk management tools, they had a better understanding of just what we talked about, they might do very well in something like that. But the key in the meme craze is not to blow up and not to get burned.
Not good when you blow up. Joe, you're focusing now. You're spending a lot of time in the Ethereum space. Take us through this new initiative for you and why it's important that you've put your name to it.
Well, our deal is FG Nexus, Fundamental Global Nexus. And I think when you think about, we kind of look at the world the way it is today, Brian, but the reality is blockchain is going to change everything. 5 years from now, the markets, settlement, stocks, bonds, options, no matter what it is, are going to be driven by what's going on with blockchain and an Ethereum or something like Ethereum. Right now, Ethereum, with regards to the blockchain and transactions, is the biggest that there is. Secretary Bessent said a little while ago that I think it was stable coins. You know, a few years ago, we never heard of them. Today, the market's 250 billion, but he says by 2008 we're going to have 2 trillion. Now, Ethereum is 55% of the stablecoin market and the token market. So as we grow and grow and grow and grow, and we move more toward blockchain, Ethereum, blockchain, Bitcoin, etc., this market is getting bigger and bigger and bigger, and it's going to take over what exists today. A little bit more so, but a little bit like the craze that took place in the 90s when everything had to be done by auction, by voice, and then all of a sudden electronic trading came in because of the internet. This is going to be a much bigger jump than that. So things that take 2 or 3 days to settle will happen instantaneously. You're able to get things validated, and then the company that has that and stakes the Ethereum so they can develop a higher yield on it. If they're doing it right, and I feel really good about our management team, there's no reason why that the stock itself or the company itself should outperform the Ethereum or outperform the cryptocurrency as time goes on. And so I think long term, it's a really, really good play. I think that the bet is that an individual company with proven digital asset management that knows what they're doing can do well enough where they can continue to grow and add to their position. And at the end of the day, the individual investor or the institutional investor wind up doing really, really well.
All right, well, good luck on the new venture. And of course,
Thank
there is
you.
more out there in the world than cash. There's crypto. Joe Moglia, always good to see you. We'll talk to you soon.
Take care, Brian. Thank you.
All right, coming up, yours truly and Julian.